The Silicon Valley Bank failure has been covered by a massive web of speculative headlines about what went wrong and what's coming next. Was it management's fault? Was it regulators' fault? Is the banking system failing? Are we heading into a recession? Is this inflationary? Is it deflationary? What does this mean for banks going forward? Or what about tech companies, or the dollar, or non-US banks, or interest rates? The list goes on. It can get a little mind-boggling, even if it's your job to stay on top of these things. So in this video, I'm gonna take you through exactly what happened, step by step, and what the potential future implications are for banks, interest rates, the economy, and beyond. Okay, so some people say the Silicon Valley Bank failure was the regulator's fault. Others say it was the management's fault, and they're both right. A combination of regulatory loopholes and incredibly terrible management, along with SVB's unique business model, the power of social media, and some bad advice from Goldman Sachs, all came together to bring down the 16th largest bank in the US in a matter of days. Let's start with the business model that made Silicon Valley Bank uniquely vulnerable to a bank run. Unlike most banks, which have a wide variety of customers, most of whom are small, Silicon Valley Bank catered to the venture capital and startup scene. That had two impacts. First, it meant their customer base was really concentrated. Venture capital funds, which are investors in startup businesses, and the startup businesses themselves often had millions of dollars invested at the bank. Typically, the FDIC only insures up to $250,000 of deposits, which is enough so that most individuals don't have anything to worry about. But for a company, that might only be a small fraction of their deposits at the bank. A, that makes them more likely to be worried and want to pull out their money. And B, it means that when one customer or depositor decides to pull out their money, that might be 50 million of deposits, boom, gone in an instant, rather than more like 50,000 for a normal bank with normal customers. So the second impact their business model had with its focus on venture capital and startup companies was that many of its customers were exposed to the same risk, and many of them talked to each other. A normal bank might have deposits from a teacher in Kentucky, a firefighter in Maine, and an accountant in California. These people are not talking to each other, and they're not exposed to the same risk. When most of your clients are either startups in Silicon Valley or companies that invest in startups in Silicon Valley, they do talk to each other. And when one gets worried and pulls their money out, others get worried and pull their money out, which is what made Silicon Valley Bank so much more vulnerable to a bank run than most other banks. After a boom in those industries in 2020 and 2021, with the ultra low interest rates and rapid growth in tech, they fell on hard times in 2022 as interest rates rose at the fastest pace in 40 years, cutting off their source of cheap funding and sending stock prices down 50 to 90% in many cases. That brings us to the failure of management, which I would point to as the primary cause of Silicon Valley Bank's downfall if I had to pick one. During the boom in 2020 and 2021, Silicon Valley Bank took in a ton of deposits. But unlike most banks whose clients are regular people taking out loans for cars and mortgages, Silicon Valley Bank customers are mostly startups that don't need and can't afford loans. So what do they do with all these extra deposits instead of lending them out? They bought treasury bonds, which they thought were safe. And in general, they are safe. But Silicon Valley Bank was way more aggressive in buying long duration bonds than other banks. They took on a lot of interest rate risk to earn a 2% return instead of a 1% return. And they left themselves seriously vulnerable to rate increases. Rates rose the same for everyone. And other banks also took in a lot of deposits and invested them in treasuries. But every other bank managed the interest rate risk significantly better than Silicon Valley Bank. And how did that happen, you might ask? Well, it turns out they had no chief risk officer for basically all of 2022, and their board of directors was totally unqualified. They took on a ton of extra risk that they didn't realize they were taking because no one who understands how bonds work was paying attention. As bad as the managers were, they couldn't have made such dumb decisions if it hadn't also been for a failure of the regulations. Since Silicon Valley Bank had less than 250 billion of assets, that's something I have in common with Silicon Valley Bank, they were not considered to be a systemically important financial institution, which meant they benefited from looser regulations. At a bigger bank, this couldn't have happened. So after 2008, new regulations were placed on the big banks that required them to hold more super safe cash and cash-like investments to protect against the fall in the value of their assets, whether it be loans they made, long-term treasuries they bought, or anything else that could go down a lot in value. Small and medium-sized banks don't have to meet the same requirements. Okay, so we're gonna geek out a little bit here, but stay with me, and I promise I'll make the next part easy to understand. Okay, so when a bank holds investments like treasury bonds on its balance sheet, it can designate them in one of two ways: held to maturity or available for sale. There's actually a third way, but that's not relevant here. When a bank designates something as held to maturity, they don't have to mark the securities to market, meaning they don't have to recognize the changing value on their balance sheet. That's because they're indicating they have no intention to sell them, and there are major consequences if they do, which we'll get to in a second. When you hold a treasury bond to maturity, you know you're gonna get your money back. So if you know you're gonna get your money back in the end, and you know you aren't gonna sell before that, then interim price changes really don't matter. That's why you can see Silicon Valley Bank had held to maturity assets they were only worth about $76 billion at the end of 2022, but they were still valued at $91 billion on their balance sheet. That works the same way regardless of the size of the bank. However, the available for sale securities are treated differently. When capital ratios are calculated, as in how many safe assets do you have to offset your risky assets, small and mid-sized banks can basically ignore losses on available for sale securities, the same way they can for held to maturity securities. But big banks have to recognize the losses. You can see here how they're basically about to add back $1.9 billion of losses on their available for sale bond portfolio to make their capital ratios look stronger. That means Silicon Valley Bank was able to take a ton of risk in long duration bonds that they designated available for sale. But when the value of those bonds went down, they were able to pretend as if they hadn't gone down when calculating their capital ratios. A bigger bank would not have been able to do that. If the big bank rules had been applied to smaller regional banks, Silicon Valley Bank would have been forced to sell some of their bonds earlier before their losses got so bad, or raise extra capital to make up the shortfall. They did eventually try to do this, but it came way too late, and some bad advice from Goldman Sachs made the problem worse. In March 2023, they found themselves in a precarious situation, about to have their debt downgraded to junk status by Moody's, a big rating agency, and earning less than 2% on a bunch of long-term treasury bonds when interest rates had climbed to over 5%. A key profitability metric for banks is called the net interest margin, which is how much interest they're earning relative to how much they're paying. Banks normally make money by taking in deposits, paying very little interest on those, say 0.1% on the money you have in your checking or savings account, and then loaning money out for car loans, mortgages, or credit cards at higher rates. Since they had locked in such low rates on their treasury bond investments, it was getting harder for them to make money. To improve their net interest margins and thus their profitability, they decided to sell a bunch of those low rate treasury bonds they were holding and buy new ones with higher yields. On March 8th, they announced that they had sold substantially all of their available for sale securities, resulting in a $1.8 billion loss. Once they sold the bonds and had to recognize the loss, instead of just pretending it didn't exist, their capital ratios looked a lot weaker. They knew this would happen, so they worked with Goldman Sachs to try to raise $1.75 billion at the same time, essentially selling off a piece of their company for cash to replace the losses on their treasury bonds. However, trying to sell the bonds and raise the capital at the same time was a critical error, and that part was Goldman Sachs' fault. Word was already getting around that they were about to be downgraded, and potential buyers of the new stock offering started asking themselves, what happens if they need to meet an uptick in redemptions? Well, they still had all those securities that they designated as held to maturity, right? Yes, but this is why it's so hard to sell those. Because if you sell any held to maturity securities, you have to recognize all of them at fair value on your balance sheet. So remember how they had $91 billion of held to maturity securities that were actually only worth $76 billion? Well, if they had to sell any of those and recognize that loss, it would have wiped out their entire equity position, essentially making them insolvent. Once investors realized that, Silicon Valley Bank failed to raise the capital they needed, which left them with a big hole in their balance sheet that couldn't be filled. Panic quickly ensued, and investors pulled out their money at record pace, which was due in part to the vulnerabilities from their unique structure with so many large customers with uninsured deposits who all worked in similar areas. And in part because social media spread the panic faster than it had ever spread before. So really, it was all Elon Musk's fault. Just kidding. So going forward, we find ourselves in a precarious position, and anyone who tells you they know exactly how it's going to play out has been drinking a bit too much of their own Kool-Aid. But here's how I'm thinking about the potential impacts. As I'm filming this, there's already been one additional US bank failure, Signature Bank, and another bank bailed out by larger companies. First Republic investors are now keenly aware of mark-to-market losses on securities portfolios at regional banks, and the sharks are circling the weak ones, trying to figure out who's the most vulnerable. Many are being priced as if they're on the brink of bankruptcy, even though that's probably not the case for most of them. The weekend after Silicon Valley Bank went bust, the regulators stepped in to ensure all deposits at Silicon Valley Bank and Signature Bank, and they also opened up a new emergency lending facility for banks. Those are important first steps in avoiding a crisis. Had they not done that, 10 plus banks could have gone under over one weekend instead of just Signature Bank, but we're not out of the woods yet. When the FDIC insured all deposits instead of just the normal $250,000 per customer, it was sort of implied that they do that for any regional banks that failed, but it's not guaranteed. They have the power to do that in an emergency scenario, but they don't have the power to provide a blanket guarantee without congressional approval. And it's likely that there will need to be more weakness and failures before they'd have the votes to get that done. The lending facility they came out with is also only good for 1 year. Maybe it will be extended, but all it really does is kick the can down the road, not solve the problem. Essentially, it allows banks to borrow money from the Fed using their available for sale securities as collateral and valuing them at par, which is what they bought them for. So they can get access to the capital they need without having to sell the securities and recognize the losses like Silicon Valley Bank did. That's great. But if they own a bunch of treasury bonds that don't mature for another 8 or 9 years, they're still going to be down from their original purchase price when the program ends in a year. And we'll have the same problem all over again. If rates go down, that'll solve the problem, but that might take a couple years, which is why I think it's likely the program will have to be extended. In the meantime, it's difficult to say when the banking crisis will end. What makes it difficult is that in times like these, fear trumps logic and fundamentals. Just because a bank will be fine in normal times doesn't mean investors won't get scared, pull out all their money, and cause the bank to go under. We still haven't really seen a credit cycle, meaning companies and individual borrowers have been in great shape and have been paying back their loans to the banks. If the economy turns down, that can make the problem worse. And I think that's fairly likely to happen. To be clear, that doesn't mean banks will go bankrupt, but it does mean that there will be more volatility in their share prices. Here's why I think this crisis makes a recession, and thus a credit cycle, more likely. Even if there are no more bank failures, banks are still going to be a lot more cautious with their lending going forward. If they're more cautious with their lending, that means it'll be harder for businesses and individuals to get loans, which will slow down economic growth. If economic growth is slower, it'll be harder for people to pay back their loans. This tightening of credit has the exact same effect on the economy as when the Fed raises interest rates. If I'm right and there is a credit cycle and a weaker economy, that's bad for the banks and stock prices in general. One interesting beneficiary could be the tech and other growth companies. Since the banks could be tightening credit on their own, the Fed may not need to tighten it as much by raising interest rates. Add a weakening economy to that, which places downward pressure on inflation and makes it more likely that interest rates will peak lower and start falling sooner than they otherwise would have. Just like how higher rates have crushed high growth companies, lower rates will help them. And the quality growth companies that can keep growing earnings, even in an economic downturn, could be a great place to invest over the next year or two. Lower US interest rates in a crisis that is mostly centered in the United States could also have the impact of weakening the dollar against other major currencies, which would be good for non-US stocks. For these reasons, a fund I like here is the American Fund's International Vantage Fund. It invests in high-quality growth companies outside the US, which is the sweet spot I find most attractive in this environment. It also comes at a low cost, and it has a long history of consistently beating the market over time, especially in down markets. Its underlying investment strategy has been around since 1987, and it's literally beaten its passive benchmark, the MSCI EFA, in every single rolling 10-year period since inception, even though it's taken less risk. So you're probably wondering, Kyle, what's the ticker for this fund? So you can find the no-load mutual fund version of American Fund's International Vantage with the ticker AIVEX. The last thing I want to say is thank you for watching. I started this channel to help Americans go from beginner or intermediate investors to expert investors. There's so much stuff on TikTok now, YouTube, so-called investing experts, and part of what I see as my duty is to call those people out. So you'll see some of my, what I call fake news finance videos. So check those out as well. But yeah, I feel like part of my responsibility to the American people or to people who want to improve their investing is to show you when other investing influencers are spreading misinformation. That being said, check out the link below. It's called the 9 Habits of Successful Investors. I asked for your email and phone number because if you're on board with me, I want you to be 100%. I would do everything I can to make you a better investor. And if you have any questions at all, please let me know in the comments below, and I will see you in the next video.